All right, welcome to Talk Tickers, where we dig into the biggest market moves. And today, we're talking Nike. On paper, their latest earnings report looked like a total slam dunk. But then, the stock just took a nosedive. We're going to find out exactly why. So here's the big question, right? Nike beats on both sales and profit. Normally, that means the stock goes up. Simple. But nope, not this time. It plunged over 10%. What in the world happened? Let's get into it. And to really solve this mystery, you can't just look at the headlines. You've got to dig deeper. Okay, so first let's start with the good stuff. Nike came in with earnings per share of 53 cents. The market was only expecting 37 cents. I mean, that's a really solid beat. And it wasn't just on earnings. They beat on the top line too. Revenue hit $12.43 billion. That's about $220 million more than Wall Street was looking for. So at this point, you're thinking everything's great, right? Well, this is where the wheels come off. This slide lays it all out, the headline versus the reality. On the left, yeah, you've got those nice beats we just talked about. But look at the right. Gross margin, a huge deal for profitability. It collapsed by 300 basis points. That's a full 3%. Then you see China, sales down a staggering 17%. And overall net income, down 32% from last year. This is exactly where that good news story just completely falls apart. So what did management have to say about all this? Well, their big message on the earnings call was, hey, we're in a major turnaround. So let's break down what that strategy actually is. The CEO, Elliott Hill, he actually used a baseball analogy. He said, I'd say we're in the middle innings of our comeback. Now, this is basically his way of telling investors, look, our win now strategy is happening. The game isn't over yet. But it's also a clear signal that, hey, we've still got a long way to go. And this is the playbook for that comeback. It's got 4 key parts. First, get back to their roots in performance sports. Second, rebuild those crucial wholesale partnerships with places like Foot Locker. Third, diversify the product lineup. It can't just be about the classics. And finally, crank up the marketing to get that brand heat back. Okay, but here's where that strategy gets a little tricky. See, rebuilding those wholesale partnerships, it's working. That part of the business grew 8%. But look at the trade-off. Nike's own direct sales, the stuff they sell in their stores and on their website, which makes them more money, that actually shrunk by 8%. And that right there is the key takeaway. The mix matters. Selling more through partners is boosting the overall sales number, sure, but it's killing their profitability. This shift in how they're selling is a huge reason why that gross margin number we looked at earlier was so bad. All right, now let's pivot to what was probably the single biggest headache they talked about on the call. Greater China. And this chart just lays it out so clearly. Look at North America. The turnaround plan seems to be working there, right? A healthy 9% growth. But that success was totally wiped out by the massive 17% decline in Greater China. It's like an anchor just dragging the whole company down. And the issues there aren't just a blip. They're deep. Management was pretty open about it. They're seeing less foot traffic, their new stuff isn't selling through, and they're having to slash prices just to move product. On top of all that, they're getting hammered by local competition and are sitting on a mountain of old inventory. Yeah, this is not going to be a quick fix. Okay, so let's tie this all together. Let's really decode why investors didn't just sell, they ran for the exits. It really all comes back to this one metric, gross margin. So what is it? It's the profit Nike makes on what it sells, before other expenses. And when that number drops by a full 3 percentage points, it's a massive red flag for investors. It means Nike is making less money on every single pair of shoes, every t-shirt they sell. And it's all because of that shift to wholesale and those big discounts we talked about. And if that wasn't enough, what really sealed the deal was the outlook for the next quarter. Management basically came out and said, hey, expect revenue to actually go down. And by the way, those gross margins, yeah, they're going to keep falling. They were basically telling Wall Street, the pain is not over. There are more tough times right around the corner. And you can literally see the market's reaction in real time here. The stock closed the regular day, no problem. But the earnings call starts at 5 p.m. And just 16 minutes in, as all these details about margins and China start coming out, the selling began. By the end of after-hours trading, poof, more than 10% of the company's value was just gone. So with all that in mind, what's the takeaway for investors? What happens next? Well, it's time for the next call. You can really see 2 competing stories here, right? You've got the bull case and the bear case. The bulls are going to look at that 9% growth in North America and the growing wholesale orders and say, see, the turnaround is working. But the bears, they're going to point straight to that disaster in China, the constant pressure on margins, the weak guidance, and of course, the rising competition from guys like On and Hoka. So when you weigh all that, where do we land? Our rating on Nike right now is market perform. What does that mean? We think the stock is probably going to move in line with the rest of the market because right now, the good stuff and the bad stuff are pretty much canceling each other out. So here's the bottom line. The turnaround in North America, that's definitely encouraging. But the problems in China are just so deep, and the pressure on their profit margins is so persistent that we just can't get more bullish right now. We really need to see some clear, hard evidence that things have stabilized before we can change that view. And of course, just a reminder, this is not financial advice.